Well, we're delighted to host Benjamin Tsai, who's the founder managing director of Wave Financial, which is one of the, I would say, the most important banks and venture capital firms in our space, in the Web3 space. I've known Ben for quite some time, and he's done some tremendous work in building this whole ecosystem out. So we're grateful that he will spend some time with us here today in the BNB Chain and Infium Founders Academy, telling us about the overview of the crypto market, which is extremely exciting topic for me. So welcome, Ben, and thank you for joining us.
Thank you very much. Mariana invited me to speak, and I actually thought about what I should be speaking about. I think in light of all the crisis and the different things that are happening in the crypto market, I thought it'd actually be appropriate for us to take a step back and look at some of the fundamentals of why we're here, what we're doing here, what the infrastructure is, and how things go from that perspective. I'm drawing some materials from the course that I teach at UCLA. I teach the Master of Financial Engineering course on crypto finance. I also teach at the Master of Quantitative Economics at the Economics School at UCLA. So pulled a few slides there, thought that would be a good start. So I'll flip through it. I think I'll go maybe half an hour, 40 minutes, hopefully, if I can talk quickly enough. And happy to open it up for questions and just generally have a discussion. And I think the point really is to try to tie some of the fundamentals and the kind of the crises in this market and really look at the evolution of the crypto market from that perspective. First things first, kind of my background. I went to Berkeley for engineering. I got my MBA out of Anderson, and I've spent about 15 years in traditional finance. I ran structured products for Merrill Lynch. And then I ran the commodities business for Merrill Lynch, also became Bank of America Merrill Lynch. And that was about 12 years of my life in Asia. Thereafter, I moved over to AllianceBernstein. I was head of alternative investments across Asia for them also. So, spent 15 years in Asia in traditional finance. I was based in Tokyo, Hong Kong, Singapore, Taiwan. So kind of really went through the whole kind of the expat experience across Asia. About 7 years ago, I came back to the US, went down the rabbit hole of blockchain and cryptocurrencies, worked on a nonprofit which led to my current teaching position at UCLA, and also started Wave Digital Assets. We used to be called Wave Financial. We just rebranded ourselves to new logo and everything. We're now called Wave Digital Assets as of March. Moving on, I think this is a chart people have seen. I was going to go update this chart a bit more, but I've noticed that the total crypto market cap is about 1.1 right now. So we've kind of flatlined from basically, kind of last year to this year in a big picture perspective. And I think it's important to note that, it is a growing market. There are a lot of people getting involved, and we just took the liberty of throwing up a lot of logos just to talk about people who have some involvement in this. And there are some pretty significant businesses that are in this space that are from the traditional world. Also, a lot of the countries and regulators have been involved, some positively, some negatively, but are looking at crypto as something that is an important subject that they're looking through. The fundamentals of why we look at that, or at least for Wave Financial or Wave Digital Assets, I still need to remember we've switched our name. We are a SEC registered investment advisor. We provide asset management, wealth management, treasury management. So we really look at crypto as an investment instrument. And I always tell people who are trying to figure out how to wrap their head around crypto, I call it another asset class that'll be added into the financial system, or is already being added into the financial system. It's kind of similar to commodities. Commodities was added to really kind of mainstream finance maybe 2-3 decades ago. Before then, if you want to do commodities trade, you call up a bank in Texas, you get something done. It's a very local thing. But then the investment banks moved into the space. It became extremely global. I think Goldman Sachs bought J. Aron. Merrill Lynch bought Inchi Coke from the Koch brothers. JP Morgan built their desk from scratch. And the commodity business became a Wall Street business. It was another desk that was added to the trading floor. I can see crypto being another desk added to the trading floor next to maybe the FX and the commodities desk. So why do we want to do crypto from a simple investment perspective? If you just take a look at S&P, and we've done this for various different portfolios for ease of understanding, we picked S&P. S&P, if you look at kind of compared to with Bitcoin edition, pure S&P, the performance over the past, so from 2016 to October 2022, the performance is about 100% if you just bought S&P and held on to it. If you added 1% exposure to Bitcoin at that time, it's 145%. If you added 5% exposure to Bitcoin, it's 327%. If you added 10% exposure to Bitcoin, it's 555%. Now, I don't say this lightly. The annualized volatility is going to go up also. And if you look up Sharpe ratio, it increases slowly. I also added the Sortino ratio, and just for not to sound too academic, but the Sortino ratio really only looks at the downside risk, so that it ignores the volatility on the upside, which kind of makes sense. Our clients don't really care if things are violently going up and they're making money; they only care when things are violently going down. So, as you can see, the Sortino ratio improves significantly, but overall, much higher annualized volatility. So a lot more kind of concerned with regards to where performances are over time. The effect is even more pronounced on the ETH side. So that's something to really look at from an investment perspective. Kind of back to the basics of what I talked about. I try to categorize different things into different categories so that people can understand it. When I teach a college course, a lot of students don't have as much exposure to finance and to the world. So for them, it's easier to just kind of think of things in simple buckets. And I do understand things are a little more gray, a little more on a spectrum than just being in simple buckets. But a simple way to think about it is utility tokens, stable coins, and security tokens in terms of the spectrum of tokens that are there. On the one end, you have the utility tokens that we typically think about, Bitcoin, Ethereum, and other coins. And these are, for the lack of a better way of saying it, these are tokens that are kind of like prepaid computer services. You're prepaying, you're buying these tokens, expecting a utility of some sort in the future. Kind of like, and a lot of people have used this example before, kind of like going to Chuck E. Cheese, buying some Chuck E. Cheese tokens. Now you can play the games, or Dave and Buster's. You buy some credits and then you could play the machines while there, and that's the utility of it. The category in the middle is stable coins. A lot of times people would like a crypto connection to the real world, and they want to connect it to currencies. So a lot of stable coins have been issued. Typically, people are issuing stable coins linked to the US dollar. The linkage, the style of linkage changes. Some people like the full fiat backed version, which is the USDC, the USDTs of the world. Some people, the crypto maximalists would prefer something that's not connected to the traditional finance world. So they would like to have things like algorithmic tokens, which would be DAI and Terra, when we'll talk about Terra as a crisis in just a bit. But basically, the idea is that it would be pegged to a US dollar in some way, and that peg will be maintained by some mechanic. And that dollar, is available for people to use to buy things that have higher volatility, like the utility tokens. The last category are security tokens. Security tokens are tokens that are issued under US or international security laws. They operate more as securities and less as currency. Some examples there, and these are older examples. This is really from the previous boom of 2-3 years ago of security tokens. People really thought that was going to catch on. There's the Aspen coin, which is a real estate token. It represents the ownership of the St. Regis in Aspen, Colorado. I think 30% of that property was tokenized. It was sold. People that hold it are entitled to dividends of that property as a owner of that property. There are other benefits that are attached to the holders of the Aspen coin. BCAP, SPICE VC, 22X Science are tokenized VC funds. VC funds have very low liquidity, so there was interest to try to generate liquidity, create a liquid market. So people issued tokens that represent ownership of the fund, and they try to list that and trade that. Liquidity markets hasn't really built out very much, so the security token discussion really in the US has not moved forward so much. But there is, on the international side, a great interest, especially in Asia. There's great interest to try to push this forward. It's top down, it's regulatory. So we were probably going to see more progress in that, in the coming days. The last thing I'll mention on this slide, and I'm probably spending too much time on each slide, is that the structure is that there is transfer restrictions on one end and no transfer restrictions on the other end. Aspen Coin, BCAP, and so forth. When an ownership is transferred, as in somebody buys a token, there's a transfer agent that's recording that ownership, and it's recorded not only on the token basis, but also really there's a log that the issuer is tracking. So it's much more of a traditional way of thinking about it. So it's really more like traditional ownership, but kept on a blockchain. On the other end, the utility tokens, you can have transfers back and forth to anonymous wallets, and there's really not much tracking. And not much tracking is not the right way to say it. All the transactions are on the blockchain. They're clearly seen, but there is a certain level of anonymity with regards to the wallets, unless obviously you go through tracking software to track the wallet source and so forth. Stable coins are somewhere in the middle. The on and off ramps have AML, KYC, and full tracking, but in transit, they transfer like utility tokens. So that is kind of the big difference among them. When you buy USDC and the US based issued stable coins, you do go through AML, KYC, similar to you opening a bank account or using your bank account. But when you draw dollars out of the bank account, you can really do whatever you want. You can buy drugs and arms and so forth with the cash they withdraw from the bank. But once you make or lose money on those transactions, when you go back to the bank to put the money in, you're back on the AML KYC side of things. You're back on the tracking side of things. So stable coins, you can think about it in a similar way. So right now, there are a lot of regulatory pressures, and that regulatory pressure really comes from the categorization of tokens. The SEC would like to categorize everything outside of Bitcoin and, basically outside of Bitcoin in the security token space, which in reality would really make this industry grind to a halt. Transfers would need a transfer agent. All transactions would probably go through an investment bank and a brokerage with a security license, and there's just a lot more infrastructure, traditional infrastructure that's expected if that was to go through. I don't think it's a good idea. I don't think it's the right way to think about it. I don't think that works well for crypto. But I think the SEC is pushing hard for that. And the pain point that they're pushing on really is not on the existence of it or the issuance of it, but on the distribution side. Because if there are securities, there's a lot of restrictions around how it can be sold, and that's the pain point that they're kind of putting their thumb on and pushing to try to get people to come into compliance. So, I'm going to skip the slide because we're running out of time, but different countries look at things differently. US, Bitcoin's under CFTC, SEC is fighting over, the other tokens. Japan uses currency law. Singapore, most everything falls under utilities. Hong Kong, I think, is more commodities, although they're changing their rules. EU is country specific for now, but they're creating unified laws coming out soon. But I'm going to just kind of move on here. This is an interesting slide that goes back to what I was talking about with regards to SEC and the restrictions on securities. If it was a security and if we were issuing securities, then there are security laws that govern it. Typically, to issue new securities, you have to go through an IPO process. The IPO process requires a registration with the SEC, a whole team of lawyers, typically an investment bank on the sell side, and other investment banks that would sell it to institutional investors and retail investors. It would be a lot of cost and a lot of time associated with that. But there are no max amounts. There's no limitation on investors typically, and there are no limitations on issuers. The SEC does offer a number of restrictions. There's Reg A, there's Reg CF, there's Reg D, and Reg S. I'm sure all of you have heard some versions of this, but they all come with different strings attached to them. So Reg A does require registration with the SEC. Sorry, the alignment is a little off on that line. Reg A requires registration. Reg CF and DNS do not. Reg CF is a small amount, but you can is capped at a certain amount per year, but you can give it to any investor. So that's convenient, but because the size cap, it is not usable for larger projects. And then there's Reg D, Reg S, which you see a lot in the investment world. And accredited investors for Reg D, non-U.S. investors for Reg S. So these are kind of the different ways you can qualify for an exemption. One of the things that the SEC is using for the test to see if it's a security or not is the Howey test. This actually came from 1946. There's some rules around what should be a security or not, and there's some challenges as to how to follow these rules. One joke I do tell our students is, Nike will release a limited edition sneakers. Sneaker fans would buy them, put them in sealed in a box, put it on the shelf, never wear them, and then trade them on an exchange. I mean, from my perspective, that fits, most aspects of a security, and therefore Nike's not in securities compliance, and SEC should be able to go after them if we're using the same format. Now, obviously, SEC is not going to go after Nike for sneakers that they sell, but I think there's a lot of holes with regards to how the determination of security is being set up right now. So, kind of taking a step forward now that we have the background covered, let's look at kind of the market infrastructure of crypto. And I'm just really going through very basic stuff, so apologies if this is kind of boring. In the grand scheme of things, from my perspective, there are really only two categories of things you do in crypto. You hold it or you trade it, right? On one side is the crypto parking place where you hold your crypto. And the other place is marketplace where you trade your crypto. So on the parking side, you can think about self-custody wallets. People have hardware wallets or people have online wallets. You can have custodians, some of which are considered qualified, some are not, depending on their licensing, domestic, international. You can have kind of prime brokerage type setups for more institutional clients, which is just fancy custody that also has, credit lines and lending and borrowing and so forth. And finally, I leave this in red. You can also leave it on exchange, which I do sometimes. So I don't want to shame people in that. But exchanges are not custodians. They have no duty as a custodian. They just hold your crypto, but are not really responsible. It's kind of a weird thing, and I think that there will be pressure bearing on that at some point. In Japan, for example, all exchanges have to be licensed as custodians. Also, it's a single license that covers both. They do have custodial responsibility, which makes a lot more sense to me. To have, for example, Coinbase run a custody business and exchange business, but say, oh, if you leave it with our exchange, we're not responsible, doesn't really make a lot of sense to me. So, I think that will come to bear. The other thing I think we're starting to see a trend in the exchange space is centralized exchanges, but using decentralized wallets or non-custodial. So people are trading on a centralized exchange, but not delivering the token to the exchange. So the exchange doesn't hold the token for the other than just during the transaction. So we're seeing that more and more. A lot of custodians are supporting that, and we think that that's interesting and the right thing to do. On the marketplace side, people know centralized exchanges. I've listed a few onshore, offshore. Deribit, Binance, the biggest exchange out there, operating mostly offshore. Coinbase, Kraken are the biggest exchanges in the U.S. Deribit is the biggest option exchange, and FTX used to be number 2 until they went out of business. And some of these in red are things happening, and we can talk about those through the Q&A if there's interest. There is, in the past few years, there's been a push toward decentralized exchange. And these are just software layers that are really where two wallets connect and they trade with each other without, kind of a centralized exchange intervention. Some people say decentralized exchange are just centralized exchanges without custody. You can argue over that. The people that run decentralized exchanges believe that they're running just a software layer. I believe Uniswap recently is getting into some, scrutiny by the SEC. So we'll see kind of how that goes. There are also developments in DeFi, so using tokens to do other more advanced financial stuff. I put Curve there as an example. There are others, Aave and Compound and many other platforms there where you can lend and borrow and do DeFi and do all sorts of more advanced DeFi things, which I don't think we'll have time to cover on this call. And then there's the OTC counterparties. So you don't have to trade on exchange. You can trade OTC. You can call up some of the big OTC counterparties and trade in large sizes. GSR, DRW Cumberland, OSL Wintermute. Genesis still trading, although parts of Genesis is in bankruptcy. So they're not seeing a lot of business immediately, but they're trying to keep that going. So, just to kind of start the conversation, and I'm going to go pretty quickly to make sure I get to kind of the end of the deck within the time I have. The initial part of crypto, other than trading, people started to do centralized finance. People are able to lend and borrow dollars, Bitcoin, ETH, and other tokens. We run the Cardano ecosystem fund, so we're always looking at Cardano lending rates, which I've thrown up here. These are not the latest rates; these were rates from before. I just wanted to give an example of that. This is back when U.S. dollar rates are quite high in the lending space, and I think they've come back to close to this level with the high interest in this space. So there is a lending and borrow market in dollars, in stablecoin, which is pseudo dollars, and in the crypto assets. Um, so some of the sample CeFi kind of lending counterparties, I mentioned GSR, I mentioned Matrix Port. We were lending and borrowing with Ledger Prime, which is actually a hedge fund. They were bought by FTX. That's why their name is in red now. They've actually unwound themselves. Also Genesis, they were one of the biggest, they're probably the biggest OTC desk, and they're going through some issues right now. A portion of them are in bankruptcy because of some of the collateral that got stuck on FTX and some of the other crises in this market. I'll talk about the crisis a little bit, and I'll talk about the Lunaterra discussion just a bit. But because of Lunaterra, because of kind of a dropping market, because of expectations of ETH that didn't happen, a lot of people were stuck in poor trades that were very leveraged, and that became an issue. I think the biggest poster child of that was Three Arrows. It's a big hedge fund out of Singapore. They were well regarded. They did a lot of great VC trades, and they were known in the market to have done a lot of good trades. So they really built up a great portfolio. It's two guys, in Singapore that had a team behind them. But it was really two guys that were running this. They built up a very large book. They were borrowing from a lot of people. They were paying very aggressive rates, and they were able to borrow a lot of money. So they took a lot of leverage on their trades. Unfortunately, they were very long in this market, and they kept going long as they were losing money. And basically, at some point, it just got caught up where their leverage was too large, and they blew themselves up. The problem was they were providing very attractive yields in US dollar terms. So the likes of Celsius and Voyager and BlockFi and others were actually giving them money or lending them money, thinking that they're generating yield on US dollars. So they're taking that 3 Arrow risk. So when 3 Arrow went under, all these firms went under also because the money was just stuck with 3 Arrows that they already lost on the trading side. So I was speaking with Babel. Babel actually last year came to our kind of events in LA, and we were very excited to work with us. And Babel said, "No, we're not involved with Three Arrows." And I said, "What are your issues now?" And unfortunately, they said they were in the same trade as Three Arrows. So in the end, they also blew up because they had the same positions. Even though they didn't invest in Three Arrows, the results were the same. So we were able to, as a firm, avoid all of these counterparties because we have a strict due diligence process across our credit counterparties, and this is what we would normally do in TradFi. So when we started this firm, we thought this is what we should do. We're SEC registered. We should look at the counterparties we work with, and I think one of the big litmus tests is we ask for their financials on a regular basis, and if they're not able to really deliver that, we don't really work with them. And there are enough counterparties that are willing to provide financials that we're willing to work with. So we were able to avoid this whole fiasco, quite well. So that's on the CeFi side. Now, kind of switching over to DeFi, and I mentioned it a little bit earlier. CeFi is lender lends the lending desk, and then you have borrowers borrowing from the lending desk. So there's kind of a centralized pool where people are putting in and taking out capital of different kinds, and the lending desk would try to kind of match the supply and demand and trade if necessary to get to that supply and demand. And they would basically be the central point to take on that risk. And that risk buffering or that market making making and that lending and borrowing and having that inventory is what prime brokerage or investment bank does in the traditional space. So it's very normal. It's something that we all come to accept. When it comes to crypto and smart contracts, people said, hey, we could do some of the stuff in smart contracts. We don't need that person in the middle. Let's try that without the person in the middle and see if we can save costs, increase efficiency, and let's just do it all in the pure crypto space. We'll use stable coins to represent, dollars, and then we'll do everything in the decentralized space using just software layers. We'll do that for collateral management. We'll do that for inventory management. We'll do that for everything. And that is basically what DeFi is. In the DeFi world, the software layer, the DeFi protocols will set up pools where the lenders and the borrowers can connect directly. The lending rates, the asset flow in and out, the way that it behaves is really based on supply and demand purely, and really based on how the different wallets that connect to it that want to borrow and lend. So all the rates, everything is driven by that. There are auto liquidation mechanisms built in so that people who are borrowing that are collateralized, the collateral could be properly liquidated. In a decentralized finance setup, typically there are no credit risks associated with this because typically most transactions are over collateralized, and that's how you can have a setup where there's not a lending desk. So that's kind of the concept behind that. Size of the DeFi market, really peaked in 2022 and really came off. And that coming off is less on pure DeFi, but really more on the fact that the market was going lower and people who are with a dropping market, people aren't really borrowing money to take exposures in a dropping market, and that's why the demand has come off. We're actually seeing demand picking up once again this year, just because the crypto market is starting to reflate. We went from 15 to 27, 26, 27,000 on Bitcoin, and the rest of the market has responded very positively this year also. So we're seeing a reflation of the DeFi market. This is an older data point from last October. In DeFi, there are so separate from lending and borrowing, there are other things that we can do. And for people who are participating in it, on the one side, people want to borrow assets so they can go do something else and make money. On the other side is people who have the assets and want to lend it to generate something, to make a yield, to make a return. And I always get a question from traditional finance people, which is a great question. Where is that yield coming from? Because if I can't explain that, or if I'm not comfortable with that, then that, is it funny money? Is it not funny money? And from my perspective, the answer is yes to everything. The first type of yield that you can generate in DeFi really is lending, right? Lending and borrowing. Somebody wants to borrow something, they'll pay an extra bit, they're over collateralized, and that extra bit basically will be captured by the DeFi platform and given to the people providing the assets, whether that's dollar or some other token. So it's very similar to a prime brokerage desk. I think everybody can understand. The second one is, it takes much longer to explain, and I won't try to do it on this call, but there are decentralized exchanges. Decentralized exchanges don't use an order book. They use what's called an AMM. This was conceptually invented by Vitalik. Automated market makers, so contractual smart contract market makers that use a liquidity pool to do buying and selling. So, once again, I don't want to get into too much detail on this particular call, but basically people are able to trade with each other using the automated market makers because they can trade with an existing pool that's already there. They pay a commission for trading, and that commission goes to the people that are providing the liquidity in the pool. For what it's worth, it's a little bit similar to the traditional order book, where the maker taker setup, where the the people who are providing the liquidity, get paid for the takers to be able to come and take orders. So it's not exactly like traditional finance, but it does have similar connections to it. The last category is what I would call subsidized yield. This is, maybe you call this funny money, but this is really people wanting to buy market share. So I've got a few examples of Avalanche and Binance and other protocols that want more people to operate on their DeFi protocol. And they would basically put up tens, hundreds of millions of dollars to subsidize trades. So if you were to lend assets into a platform, they will give you an extra 10 basis points of yield or 50 basis points extra of yield, and that's paid in their native token. And you can take that, you can keep it, you can sell it to cash out on that extra yield. You can do whatever you want to it. But because you showed up and provided liquidity, you're going to get a little bonus. You get a little tip. And the same is the other way. You will get a little tip even if you are borrowing assets. They're basically tipping everybody on both sides to try to get more people to come and use the platform. So if you're borrowing, your borrow cost is lower because you're getting that extra tip. And if you're lending, you get paid a little more because of that extra little tip. So some people say, hey, that's not good. That's just VC paying to buy market share. But that's true of a lot of startup business, right? I get, I don't know, Grubhub coupons all the time. This is similar to what we're talking about. They will subsidize your use of these platforms to get you to use the platform more in the hopes that this becomes a much bigger market where everybody will be operating on DeFi. The volume also supports more work for people to be building more different features in DeFi. And we've seen that throughout 22 21 and 22, where new DeFi platforms and capabilities and technologies are being built and being done. Some of them are not the greatest technology, but we're at a point where we're just experimenting with new different variations of what we can do with finance. And to me, it's extremely exciting for someone who's been in finance for 2 decades. Um, there are some good experiments and there are some experiments that didn't work so well. So I'll talk about the Luna Terra one for just a bit. I am running out of time, and I think that there are many, many more slides to go, actually. So I'll talk about Luna Terra a bit. I think there's a discussion of stablecoins, and we talked about stablecoins a bit. People are interested in having stablecoins, and I think the crypto maximalists would like a stablecoin that's not connected to traditional assets. So the discussion is, let's do algorithmic tokens. Algorithmic tokens, it uses a crypto algorithm uses an algorithm to connect the value of the assets to another crypto asset. So if you connect to another crypto asset, then you can use that as a benchmark. So that's how Luna and Terra is set up. Terra is set up to be pegged to $1, and Luna is traded at some floating price, and you can use Luna to buy Terra. So if Luna was worth $1, you can trade Luna for one Luna for one Terra. If Luna is worth $2, you trade one Luna for two Terra. If Luna is worth half $1, then you can trade for half of that. Or for 2x that. So that's just a very simple relationship. So the other thing that the Luna Terra guys, Terraform Labs, did was they set aside a big honeypot to subsidize people using Luna Terra. So all they said is, great, if you use Luna Terra, or if you hold Terra, you will get paid 20% per annum. We are going to subsidize that, and we're going to fill the pot. We're going to subsidize that for as long as we can. People said, great, that's a US dollar exposure, and I get 20% per annum on a DeFi platform. This is great. Let's do that. So to get to Terra, you have to buy some Luna. So people bought Luna, convert to Terra, put it in, make their 20%. And then more people bought Luna to do this. So the value of Luna started going up a lot. And people said, this is great. Let's buy more Luna. And then some of them will convert to Terra to make 20%. Some people just stay in Luna because Luna is going up so much. That also drove Luna to go up more. And Terra started building a big LTV, the kind of the value or value locked in there. And that's something that is really exciting for or TVL, total value locked. So that was exciting. Oh, this is a really stable network. There's a lot of money that's locked on this platform. People then took Terra and used it as a stable coin on a lot of the DeFi platforms, did all sorts of things with it while they're making their 20%. So, people became very creative and did all sorts of things. The crack started to show somewhere early last year, where the pot of money that Terraform Labs, was setting aside started to run out. They topped it up a few times, but at some point they were going to run out of money because there's just so much Terra out all earning 20% per annum. So things started to become a little shaky. People are looking at kind of maybe that should be depegging. We noticed that not necessarily the depegging itself, but we started noticing that a lot of the DeFi pools, people were draining the non-Terra assets. People are leaving the ecosystem and dumping Terra. So we were not very comfortable. We saw this Saturday, May 7th. And we started taking our clients out of that trade. Until that point, our clients like earning 20% per annum. We thought that was a fair risk. We had our clients on the trade, but we pulled them out on Saturday. We could have stayed an extra day, I guess, but it's good we didn't. On Sunday, things started to become unstable. Not only were the pools imbalanced, the token started to depeg, and this is the price of Terra, which is supposed to be $1, right? So it's pretty flat at the beginning. It started to break and really begin to fully depeg by Monday, and you saw that kind of really break down. So this was a tough trade. The moment people wanted out, when everybody wanted out, they would take their Terra and convert to Luna and then dump Luna in the market. As more people dump Luna in the market, the value of Luna started going down. So as the value of Luna started going down, every Terra is worth more and more and more Luna. So every person that showed up later to do this got even more Luna, and then they would dump it even more Luna into the market. So that would drive the market further down. So that was so on the way up, it was a very positive, leverage accelerated event on the way up. And unfortunately, it's the same on the way down. It's a very accelerated leverage speed on the way down, kind of a death spiral, very quickly. By Friday, we're trading probably, at 10 cents on the dollar on Terra, and Luna basically goes to zero. And that was over a span of basically a week. Right. So it was very hectic. I also know certain traders who were short this thing, and then that one big rebound in the middle really blew them out. Some of them had kind of leverage positions that they couldn't cover, so they lost money on the trade. So it was actually just quite a terrible trade overall for the industry here. And this also triggered losses for Three Arrows and a few other places that really ultimately triggered the downfall of all of those. And later on, FTX put on a brave face and kept going, but in the end, I think they also lost a lot of money on these trades. On a more happier note, there are other things that are being done. So right now, we are trading on behalf of clients in DeFi. This is one of the trades we actually do. We do it on the GMX network. We acquire GLP tokens. This is a stable coin linked to 8 different tokens. The key point we had a problem with Luna Terra that we were always concerned about at the beginning was Luna and Terra are all issued by the same company. It's relatively incestuous. If one does well, the other one will do well. If one doesn't do well, the other one will not do well in both directions, right? So that correlation was really a problem, whereas GLP is issued and linked to 8 very large tokens: Bitcoin, Ethereum, Uniswap, and Link, Chainlink, and then also 4 of the other stable coins. That's USDC, DAI, Tether, and Frax. So because of the fact that it's linked to 4 stable coins and 4 very large assets that are not related to GLP, we were very comfortable with this. We have clients that we help that buys this, and we would hedge out their volatile asset exposure on the Bitcoin, ETH, Chainlink, and Uniswap, so that they have only exposure to the stable coins, which is dollar exposure, and then we're able to capture yield for them. This trade would capture, at the time of me making the slides, about 18% per annum yield. So that's an attractive yield with basically US dollar exposure. Now, this is not a free trade. Our hedge has to be effective. If you don't hedge often enough, you lose money on the slippage. If you hedge too often, you lose money on the transaction fees. So we monitor that, and we balance that out to try to get to kind of 18% per annum when I made the slide. I think the yields are a few points lower right now. Maybe it's around 16 right now, but that's what we're looking at. And this is what we do in the DeFi space. I'm going to skip this slide, but I think people are going into hybrid models for DeFi to connect traditional assets with DeFi, and I find it very interesting. Maple has had some issues because they did have trades with with credit risk, and that wasn't as well handled. Goldfinch is doing emerging market debt connected with DeFi, so it's CeFi it's CeFi on the back end, DeFi on the front end. Maple and Goldfinch were both like that. And I wanted to get to this slide before it's over. I think one of the things that I will talk about kind of more recently is really the regulatory pressure being applied to crypto. And in the past I guess 2 weeks ago, we went through kind of a crypto banking crisis, for the lack of a better way of saying it. And I put a question mark behind that because I think it's more than just crypto banking crisis. I think it was a banking crisis, or it is a banking crisis. Silvergate was one of the largest bankers to the crypto space, and they're almost exclusively focused on the crypto space. They basically, went out of business because they were not able to handle, all the withdrawals that came in, which is a real shame because I think, Silvergate ran a decent business and was very supportive of the crypto community. They also had a network called SEN, SEN, that was a crypto backed fiat transfer system that was very good. So between counterparties that are in this space, we can all send money to each other instantaneously in fiat, as opposed to wiring something, have it show up the following day, and all of that. We did not use Silvergate, but this is a feature that I thought was very good. Signature Bank also had something similar called Signet. We did use Signature Bank. Signet was great. We use that for our OTC counterparties. We use that for transfers in between our funds and with our clients and so forth. Anybody that's set up on Signet, we were able to transfer, basically US dollars instantaneously. And it kind of begs the question, why doesn't all banks work like that? So that was great. And then I think that the three failures, in the past 2 weeks were really Silvergate, Silicon Valley Bank, and Signature Bank. So I'll talk about Silicon Valley Bank as an example of, not really crypto related, but they had a fundamental issue, which was, very much linked to, the banking system at large. Banks typically take on deposits and then they deploy the deposit. So they deploy on liquid and illiquid things. They deploy on illiquid things like giving people, home mortgages and things of that nature that are very long dated. Investment banking has progressed where people can package that up and make it a little more liquidity out of it. And then people also bought treasuries. Treasury rates have been going up, and people are excited by the treasury rates. But rewind 3-4 months ago when treasury rates were not up, or let's call it 6 months ago when treasury rates were not up, people still had to operate a bank. So when you had a lot of cash, you want to generate as much yield as you can as a bank. You end up buying longer dated US dollar treasuries so that you can hit that yield that you need. That longer dated treasury means that you will get back par much later, and therefore the valuation of those treasuries is not at par at the time you buy it, right? The lower the rates, the lower rate stuff that you buy, when rates go up, the valuation of those bonds go down, and that's how it works in finance. And what has happened is they loaded up a lot on the longer dated bonds and held it because they needed the yield. And then when the U.S. government increased interest rates, unprecedented, very, very high speed in a very short period of time, all of those long dated fixed income instruments, even treasuries, which are fully safe, dropped significantly in value. They will all go back to 100 at maturity, but because maturity is further out than normal, people are buying up to 10-year papers, the valuation became very low. At the same time, when the economy is not doing well, people are taking money out of the bank. And when they run out of cash to give away, they have to go sell what they have in inventory to make cash to give to the clients. And guess what? What they have in the inventory is not worth 100% of the value that they thought they had. So that's a big problem. That's a problem that we already knew in the finance system. Money market funds, if you go look at the rules that govern money market funds, they're not allowed to buy long dated instruments, even if it's treasuries, right? So finance people already knew that that's a problem, but nobody kind of cared to tell the, fixed income trading division at banks that they cannot do that. And they went and did that. So, so that's kind of what blew up Silicon Valley Bank. At the same time, the New York regulators went and seized Signature Bank at the same time, claiming that they also had balance sheet issues. The management of Signature Bank says that they didn't have balance sheet issues and they were seized because of their crypto exposure. They had about a 20% crypto exposure. So, we were one of their clients. And our bank account is fine, no issues right now. It's fully operational, it's guaranteed by the government now for the total deposit, so there are no issues there. But they were taken over, because according to management, it's because they do crypto, and according to the government, it's because they were illiquid. So, it wasn't very clear as to where that landed. I think there was kind of a lack of clarity until last weekend. There was an announcement that said that Signature Bank has been sold to another bank in the state of New York, and everything is transferring over other than the crypto clients. So that kind of begs the question, why aren't the crypto clients transferred over? And was it a targeted attempt at kind of shutting down crypto banking by the New York regulators? And so, that's an unfortunate, question that's outstanding. And I don't know what the New York regulators are going to take from a positioning perspective. And, are they going to say Signature Bank didn't have a bid license and therefore they can't do banking with crypto people? I think that's a overreach, but that could be their explanation. They haven't given an explanation. Now they've sold 80% that is not crypto to the local bank, so the local bank is operating normally. What are they going to do with the 20%? The New York regulator is not going to run that 20% forever. So we're obviously transferring, moving to other banks. We have other banking relationships, and we're moving to other banks, but that's certainly becoming kind of a major problem. So I'm sorry, that took a little bit longer than I thought. So we're at kind of 45 minutes in. I'm going to pause here. I'll open it for Q&A. I know there's also a Clubhouse session afterwards. I've not been in Clubhouse lately, but I'm sure I have the app installed somewhere on my phone. So I'm happy to jump on the Clubhouse afterwards, also, if that helps. So.
Well, first of all, Ben, we can listen to you like for another 2 hours if you have them. So don't worry about that. In terms of, Credit Suisse about to fall apart, how's that related to crypto?
That is not related to crypto. So a lot of banking issues right now are not related to crypto. The buying long bonds with rising interest rate is not a crypto problem. It is a poor fixed income, tenor management problem, right? It's really it has nothing to do with crypto. Credit Suisse has had a lot of issues. They don't deal with crypto. I'll start there. I've talked to them a number of times. They absolutely won't touch crypto. So it is not crypto that brought them down. They've had a lot of issues with management. They've had a lot of issues with compliance. They kept dealing with clients that are not they shouldn't deal with. And I think as their business got worse, they were more incentivized to deal with clients just because they're trying to support their business, and at the same time they're the business that they shouldn't deal with. So it was a problem coming. So they've been, I would say, they've been limping along for the past year and a half, and the situation has just gotten worse and worse and worse. And I think people just lost confidence in them. And at a bank, I mean, confidence in the bank is really all that's left. So right now, they're going to be absorbed into UBS, and we'll kind of see how that goes.
So in terms of how stifling is this for the US based crypto markets, what's happening with banking?
I think it's extremely negative. So it's extremely negative overall for the tech space. Silicon Valley Bank, I don't think has been sold yet. I'm a little surprised as to why it hasn't been sold yet. I think it's a great asset to own. I think their client base would be great to have. Now, obviously, people would probably want to buy this out of bankruptcy because they don't want the liabilities that come with SVB. And I'm sure the government would be happy to throw in a sweetener for the right buyer, but we haven't seen anybody come in and buy. I have a bad feeling that it's because they're trying to not have international buyers come in and buy, because there's a lot of strategically important things that are in SVB. A lot of the startups with leading edge technology, with new developments, SVB has full access to their balance sheet, their business model, what they're doing, and so forth. So there is a security concern with having SVB be sold to, let's call it a Chinese bank, for example, or a Russian bank. Of course, they'll probably be out of the question. And even some of the other foreign banks, are they comfortable with that? If I were one of the Middle East countries, I'd just buy Silicon Valley Bank just for access to all the new technology, right? That's something that they've always wanted, and this would be a cheap purchase, right? So I think the government is leaning more towards trying to get SVB to merge into one of the more US entities just from a strategic perspective. And I don't know how that is going to go. Very specifically with crypto, I think with Silvergate not being here, with Signature Bank not being here, and I don't really see a path for the crypto side of Signature Bank. I mean, it's pretty obvious that the New York regulator is not going to run a bank that just services crypto. So I think that road will end somewhere, in a few weeks, in a few months. There are other smaller banks that are continuing to service crypto, and people are drifting to that. So the question then becomes: is the SEC going to, or the regulators going down the whack-a-mole of going after all of these banks? And it is, I feel like it's kind of a witch hunt. I really don't know why that would be an issue, but I think there's that. And I think very unfortunately, it leads to the question of, should we be operating offshore? Should we have offshore bank accounts? We're in active discussion with a lot of offshore banks to see if we can open accounts with them. And, if you draw the extension, should we not be operating our business in general here? Should we be operating it offshore? And that's also not a good discussion for the US. We spent some time with the regulators in Washington, D.C. 3 weeks ago. I was out there 3 weeks ago. We were working with the Milken Institute. There was a 1 day digital asset conference. We had Senator Loomis, we had Senator Gillibrand come speak about it. We hosted a dinner the night before. We had White House representatives from the two senators' office. We had Caroline Pham from CFTC. We had all the we had a former attorney general, and we just had kind of all the right people there. And the discussion is that right now the system is not very receptive to pushing crypto in a positive sense, but from a national security, from a national competitiveness perspective, there needs to be. So I think everybody's very conflicted there. And I think the recent report by Biden is really bashing crypto also. So it is becoming a much tougher environment for crypto to work. And people take the path of least resistance, right? If it's tough here, maybe we do it in Europe, maybe we do it in Asia, we pick a more friendly jurisdiction. And why do we have to bang our heads here for the bulk of what we do? And unfortunately, we're starting to see that. And I'm hoping that this doesn't get any worse. But, it does look like it is not getting better. SEC's taken action, or about to take action against Coinbase, and they took action on Paxos before that, Kraken, and in between. And, the court case with Ripple hasn't been cleared either. And so it's just it's a lot of negative overhang in a very strategically important technology in space.
We had a suggestion. We have a bunch of companies in the DeFi space because BNB Chain is a leader in sort of creating opportunities for DeFi development and growth. If you want to maybe give the second part of your lecture, we can schedule you for that either next week or the week after, and go through all the slides, because we feel this is extremely important for us as a group. And most of our founders are not really early stage. They're kind of later stage. They've raised money, they have uptake, they have major partnerships with enterprise clients and stuff. So it would be very behooving for them to hear everything that you have to say in this presentation.
Yeah, so I've gone through all the slides I wanted to go through today, so there's not necessarily a second part. The course I teach at the Master of Financial Engineering is 30 hours, so I'm not going to go through every single slide. So it's like, great, let's do the rest of the slides. Well, we're not going to spend another 29 hours on this, so we're not doing that. But I'm happy to be available, happy to chat, I'll I guess we'll switch to Clubhouse at some point. Happy to continue the conversation. I see a few questions in the chat. I'm sorry, actually, I haven't been reading because I've just been babbling, but I do see a few questions here. Let me kind of read that as we go. Yeah, there's a comment with regards to Spanish banks. I know I don't know if BBVA is very active in crypto. I know Santander is very active in crypto and fintech and so forth. So it doesn't sound like it's as stifling in Spain as it is in the US. And good for you guys. And I think we're always looking for kind of crypto friendly jurisdictions while we figure out what to do. Obviously, US is a big market. We would love to operate in the US. We made a decision to do that. That's part of why we got SEC registered. And we want to do things the right way. I think that the next question is, stewards of capital, higher standards of verifiable reporting. I think that people should be reporting in a proper way. I think that TradFi is making an attempt at doing proper reporting. Yes, there are also TradFi financial crises like all of the things that we've seen before. But I do think that crypto is heading that way. I think the question comes down to, what are the regulations? What should be reported? What should not be reported? And the SEC is not ruling by regulations or guidelines, but at the end of the day, they are pushing. They're really ruling by enforcement. And one example I heard in Washington, D.C., which I thought was very appropriate, it's like we're all driving down the road with no rules. And then somebody makes a left turn, they get pulled over. Okay, I guess we can't make left turns, right? Oh, somebody else got pulled over because they're driving faster than us. Okay, maybe we can't drive that fast, but I don't know how fast is fast. Oh, some guy really slow got pulled over. Okay, so we can't drive too slow either. But we don't know. We're just looking at who got pulled over, and those become kind of landmarks of things that we shouldn't do, and that's not how law works, right? So I'm kind of hoping that Congress steps in and actually sets some real rules so that the SEC can enforce those rules, as opposed to SECs putting markers on the ground or cones on the ground saying this is how we think things should be. There's even disagreement within the SEC, right? I think Gensler's taken a very hard stance, and you have Hester Pierce, trying her best to, come up with counter arguments to a lot of things that are going on. And I think that it is not universally agreed that SEC should be taking such a hard line, but Gensler as the lead is taking that hard line. So it's quite unfortunate the way that it's being done right now.
So, in terms of some of the traditional finance development that you're probably familiar with, has come through a lot of litigation over the years. Like if you look at FINRA rules, which, when I was taking Series 6 in 2018, I realized that a lot of the FINRA rules were a byproduct of litigation. Is that sort of the way that this is being handled as well? Is like through litigation, kind of creating some set of rules?
Yeah, I think the traditional finance world has had many more years to put guide rails around, and innovation was much slower. If you looked at DeFi innovation in the past 2 years, it's probably 10 years worth of TradFi development in terms of thinking about DeFi, using smart contracts, and so forth. So the regulation is not quite able to keep up. I would say in an ideal world, the crypto guys will all get together and say, hey, let's make a self-regulating entity, or let's make a non-governmental regulating entity, and we'll have that regulate us with the guidance from rules and from the government. The reality is that well has been poisoned. I think we've gone through a few rounds of that. It hasn't really worked, and the regulations haven't come out. So it's hard to think that that would be the solution at this point, although I think some of us are trying going down that path. And I think a lot of regulations also come from, scandals and so forth, Madoff and Enron and so forth. And oh, they were doing it that way. Okay, let's put rules down so that we make sure they don't do it that way, right? So, the whole Dodd-Frank discussion. We had Glass-Steagall, and then we repealed it, and kind of the cycles of all of this. And so rules are kind of being adopted over time with markets, and I think the same will be true for crypto. But you got to start somewhere, and we don't have a starting set of rules that gives us a fair playground to play with. I think is where that frustration is.
So thank you so much to teaching us all this and to putting it in a perspective that's a big global perspective that makes a lot of sense. And we'll pick it up in the clubhouse. And thank you for joining us. You have to join with your cell phone, I think, to be invited to speak.